ladies and gentlemen. I'm Hiral Dadia. We have with us Ms. Aditi Nair, Chief Economist at ICRA, joining in. Aditi, welcome to the show, and always a pleasure to speak to you as well. Aditi, my first question coming to you is, if you see in terms of, the CPI data that has come out over the week, inflation at around 7.04 in the month of May, pretty much in line with what the street was estimating. What's the sense that you pick up?
Thanks, Hiral. It's always great to chat with you. So, starting with the CPI, we had actually pegged it at 6.9%. So it was a tiny bit higher than what we were expecting. But the good news was that the services inflation momentum was a little weaker than what we had feared. And this is something which is very important because we do see that in FY23, it's going to be the services sector that is really going to see a big demand revival. And that is where we're going to see the high growth coming in. And therefore, it is possible that an uneven demand skewed towards the service sector could end up being one of the factors driving inflation going ahead. So to start with, the origins of this high inflation episode are more global in nature, but inflation has become more broad-based over the last few months, and that is really a fear. Added to that, we've had our domestic issues in terms of the heat wave, which has affected the wheat output as well as vegetable prices. And now it looks like the monsoon is a little bit delayed. Sowing is really not picked up. It's very early days, of course. July is a lot more critical for sowing. But some of the items on which food inflation is high, being driven by global factors, that may not come down in a big hurry. Secondly, wheat, where we have a domestic inflationary issue as well, that is a rabi crop. So it's only going to be planted after October, November. And therefore, even a good monsoon may not really be enough to bring down wheat prices in a hurry. So there are some concerns on the food side. There is an apprehension that a strong service sector demand could, add to inflationary pressures and keep core elevated. And what happens if crude oil prices rise further going ahead and need to be passed through to the pump prices? We don't have that buffer of high excise duties anymore. So these are some of the concerns that we have. We do, however, expect that the CPI inflation will be on average around 6.5% in FY23 with an upside. So in the general ballpark of what the Monetary Policy Committee had indicated in the last policy review. However, we expect that both demand to be more back-ended in FY23, and therefore we expect the CPI inflation prints to be a little lower than what the MPC has penciled in the remainder of H1, and maybe a little bit higher than what they penciled in Q3. So we differ in our quarterly forecast, even though our headline inflation and growth projections are pretty much in line with the Monetary Policy Committee.
Right, so 6.5% is what we're projecting for FY23 in terms of CPI with an upside, right?
Yeah.
Right. So with this, by how much do you think that the RBI could raise rates from here on over the next two meetings with inflation above the 6% target?
So the view we have is that a lot of the inflation is still originating from global and supply side factors. The demand in India right now is uneven, and it's not we can't categorize it in the same sort of excess demand situation that the US is in, for example. So we don't think that we need to mirror the US Fed and go in for very high and front-loaded rate hikes. As of now, we think that a 35 basis points rate hike in the August policy and a 25 basis points rate hike in the September policy to bring us up to 5.5%. Seems to be appropriate, with a pause after that to really understand what are the dynamics of growth and how both the high inflation and the monetary tightening are affecting the growth side of things.
Right. And overall, if you see with this, how are you expecting the growth angle?
So our view is that in the current quarter, there are some signs that the global headwinds and the inflation headwinds may be impinging upon the discretionary demand, particularly for the lower to middle income households. And when we look at the GST e-way bill data, for example, the daily average generation of GST e-way bills was at a 4-month low in May. So we think this is perhaps a hint that there is some pain being caused to household budgets because the items on which there is high inflation are everyday or every week consumption items. Things like vegetables, edible oil, fuel prices. It's not like the big consumer durables where you make a purchase once in a year or 2 years or maybe even longer. But a lot of our daily use items are seeing high inflation, and that's something that very quickly transmits into the household budgets. So there will be some demand compression, particularly for the low to middle income households because of this factor. However, there's another view we have, which is that people are going to prioritize the consumption of services, particularly in the middle to higher income households, whether it's eating out, going to watch movies, taking longer holidays, not just staycations or driving vacations. These are the things that we expect that the middle to higher income groups are going to prioritize their spending on, which means that consumer durables may not really be in vogue at this point in time. So again, it's something that corroborates our view that the services sector is going to gain, whereas the manufacturing sector may not really see very good times in the immediate term. And then there will be some households that really did not have any income certainty in the last 2 years, particularly those that derive employment from the services sectors. And therefore, their consumption in any case may be better now than what is within the last 2 years. So overall, it's a very uneven demand scenario. And we do think that the growth in terms of the real GDP is probably going to be in the range of 12 to 13% in Q1, 6.5 to 7% in Q2, and then 5 to 5.5% in Q3 and Q4. That's the quarterly projections that we have right now. So again, a little different from the RBI or the MPC. Our Q1 projection is lower, and our Q2, Q3, and Q4 projections are a little bit higher.
If you could just repeat, Aditi, the Q3 and Q4 projections.
We are looking at a 5 to 5.5% real GDP growth in Q3 and Q4.
Okay, got it. So taking this into consideration, and overall, if you see, even from the government program, borrowing program, do you think that they will be able to commit the completion of the same, because they've reiterated their commitment already?
See, on the Government of India fiscal math, there's a lot of positives and negatives. The positives are that we think that the tax revenues are going to be significantly higher than what was budgeted, even after the excise duty cut. And the LIC inflows spilled over to this year from last year, even though they may be a little more modest than what was initially being hoped. And the negatives are that we have higher subsidies, that really are now already adding up to a fairly large amount. However, when we net it all off, we right now are expecting the fiscal deficit overshoot to be at worst rupees 1 trillion. And this is if there are no expenditure savings found. And that, expenditure savings are found when situations are tough. So at worst, the extra requirement for borrowing would be 1 trillion, although really it would be much lower than that. So perhaps one thing that can be considered is doing a reset on the small savings rates in the next review, which is coming up in a couple of weeks, because the repo rate has gone up, GSEC yields have gone up. So maybe it's a good time to sort of, do that transmission to the small savings rates as well, and reduce that apprehension that the dated borrowing program will have to be enhanced significantly. And that is something that can prevent yields from going up too much.
Okay, so where are you expecting the 10-year to trade, at what levels?
So over the next few months, we expect that the 10-year is going to rise further. We are looking at it ranging between 7.75 to 8% over the rest of this calendar year, depending on what kind of measures the RBI unveils to be able to ensure the orderly completion of the government borrowing program that they had alluded to. And really more important than what are the measures is what is the magnitude of these measures that the RBI is going to bring forth. So that is what we think is going to be able to determine whether yields settle at 7.75 or they go all the way up to 8%, because there is more, both the Fed, of course, we are expecting significant rate hikes over the next few months. But even from the RBI, from the MPC, we do expect 2 more rounds of rate hikes before they go in for a pause. So this is going to add to upward pressure on the 10-year GSEC yield.
Right. And overall, if you see in terms of the US, as well as if you see in terms of the Europe as well, the way the inflation has been spiking, they have been aggressive with regards to liquidity squeezing as well as increasing rates. with their aggressive move, what's the impact that we could see?
See, as far as India is concerned, we've seen the rupee slipping past 78 a couple of times this week, and we are watching to see where it kind of settles. But perhaps a slightly weaker rupee is definitely something that all businesses who have export or import dependence should be prepared for. As of now, we still expect that the low for the rupee may be restricted to 79. We're not sure that it's going to cross that, but the next few days will be quite critical to sort of see the dynamics from what the Fed has now said over the next 6 months and how that's going to affect both their yields, our yields, as well as the rupee.
Okay. And then overall, what are the key risks that we are watching out for?
See, in terms of risks, certainly does inflation sort of settle and then start tapering down? And what kind of an impact does that have on the, mindset and the inflation expectations of consumers as well as on their consumption patterns going ahead? This is something that is going to determine where growth ends up. And, it will also have an impact on things like, at what point do the FII equity outflows stem? The consumption outlook and the growth outlook is going to play a factor a few months down the road when the geopolitical tensions and the Fed related movement takes a breather.
Right.
Monsoon is another risk.
Yeah, go on, Aditi.
Yeah, monsoon is always a risk at this time of the year. We're always sort of, watching for what is the pattern going to be, the progress, and the distribution. So this is something that we're also watching out for. We do think that there is a chance that acreage is not going to go up in a significant manner this year as compared to the last 2 years, simply because a lot of the surplus labor that was in the rural areas since 2020 would have come back to the urban areas to their service sector jobs now. So we're not very hopeful of an increase in acreage, which is meaningful.
Mm-hmm. Right. And how big a risk is crude right now?
It certainly is. We are concerned from the point of view that when we saw the last 2 episodes of crude oil going up, the excise duties were still significantly higher than the pre-pandemic level. So we knew that there was a buffer that could be utilized to be able to reduce the pain from the crude oil price increase. Now, excise duties on petrol and diesel are back at the pre-pandemic level. So this buffer, it's not really there as something that you can quickly, look toward. And state governments are unlikely to reduce VAT in a hurry when they're right at the end of their GST compensation 5-year transition period. So we don't have that, tax buffer to be able to reduce the pain for consumers. So it'll be interesting going ahead, to see what kind of transmission needs to happen to the retail selling prices and how that sort of, split between the consumers and the government taking a hit on the tax revenue collection.
Right. So these are a few things we should be watching out for as well. Thank you, Aditi, so much for joining us on the show because, this is going to be a crucial time for all of us to actually understand which stride we take, taking the global situation into consideration. But overall, my last thing would be, would you say we are in a much better shape than the other economies?
I think so. I mean, if you look at our Q4 data, for example, and we compare it to pre-COVID, we were the fastest growing economy. And we have, I keep saying uneven demand, but there are pockets of demand being strong and resilient as well. And I think I'm hopeful that that's going to tide us through this year.
Absolutely. So let's see what happens from here on. But thank you so much for joining us on the show.
Thank you, Viral.
To speak to you. Thank you. Stay safe and speak to you soon again.
Bye.
Subscribe to our YouTube channel for in-depth interviews of India Inc. and press the bell icon so that you do not miss our updates.